What if I told you that you don't need to be rich already to become a millionaire? You don't need to be a stock market genius with insider knowledge or fancy degrees. And you certainly don't need to chase risky, speculative investments that promise overnight success, but often end in heartbreak. To become a millionaire, there's a much simpler, more reliable path. In fact, with just $50 a week, a healthy dose of patience, and the right ETFs, ordinary people have been quietly building serious wealth for decades upon decades. These strategies have stood the test of time. Today, I'll reveal 3 of the safest ETFs you can invest in right now, and I'll walk you through 2 concrete, real-world examples showing exactly how $50 a week can compound into $1 million over time. Let's get into it and start transforming your financial future. To truly appreciate the potential here, let's crunch some real numbers with 2 specific examples of how this works through the power of compounding growth. Example 1. You invest $50 per week, every week without fail, in safe ETFs averaging a 9% annual return, which aligns with long-term US market history. Over a 40-year time horizon, your total contributions amount to $50 multiplied by 52 weeks times 40 years, equaling $104,000 out of pocket. But here's the incredible part. Due to compounding, where your earnings generate additional earnings year after year, your portfolio could grow to approximately $1 million or more. That's not hype, not hustle, not luck. It's the mathematical reality of time working in your favor. Now, example 2 for even more aggressive yet still safe growth. $50 per week at 10 to 11% average annual returns over 35 years. Total contributions, roughly $91,000. Final value, again, over $1 million. The real differentiator? Staying consistent through thick and thin, reinvesting dividends to fuel more growth, and never panicking during market downturns or crashes. This is how steady investing turns modest sums into life-changing wealth. These ETFs aren't about getting rich fast through gambling on hot tips or trends. They're about getting rich for sure, steadily over time, through broad diversification and long-term performance. But before we name them, let's clearly define what makes an ETF safe in the first place. A safe ETF embodies several essential qualities: broad diversification, which spreads risk across many assets; long-term historical performance backed by decades of data; low fees that maximize your returns; exposure to the entire US or global economy; and minimal dependence on any one company or fad. Broad diversification ensures that no single failure derails your progress, much like a team of experts collaborating to achieve stability. Long-term performance means it survived real-world tests. Low fees mean less drag on growth. Economy-wide exposure captures overall prosperity, and avoiding over-reliance prevents big losses. Together, these create a fortress for your money, prioritizing sustainable wealth over volatile shortcuts. One standout example is a total US market ETF, which owns thousands of companies spanning every key sector: technology for cutting-edge innovation, healthcare for indispensable services, finance as the engine of commerce, consumer goods for daily essentials, and energy to fuel progress. This pie chart breaks it down perfectly. Instead of risking it all on one company that might stumble, you're placing your bet on the strength and resilience of the entire US economy, the world's largest and most dynamic. Historically, this broad US stock market approach has delivered around 9 to 10% annual returns over the long term, navigating booms, busts, and everything in between. That's why a total US market ETF is widely regarded as the bedrock foundation of any safe, balanced portfolio, providing stability and growth potential in one efficient package. Building on that foundation, our second safe ETF is an S&P 500 ETF. This tracks the 500 largest, most powerful companies in the US, true titans of industry, the strongest businesses on the planet. Think global brands you use every day, undisputed industry leaders, and adaptable giants that innovate and endure through challenges. The S&P 500 has weathered wars, deep recessions, brutal market crashes, and even global pandemics, always emerging stronger and continuing its upward trajectory over time. It's one of the most battle-tested and trusted long-term investments ever devised. For even broader protection, consider ETF number 3, a total world stock ETF. This gives you diversified exposure across the US, established Europe, fast-growing Asia, and promising emerging markets. If one region falters or slows, others accelerate to compensate. It's ultimate global safety without depending on any single economy. Ideal for hands-off, maximum diversification. If you commit to just $50 a week, select safe, diversified ETFs like the total US market, S&P 500, or total world stock we've covered, and give it the necessary time of decades. You're not gambling or guessing your future. You're deliberately building it, step by step. Most investors fail not from bad ETF choices, but from quitting too soon, panicking in downturns, or chasing hype over discipline. Avoid those traps, stay the course with consistency and reinvested dividends, and watch compounding do the rest. Symbolized by nurturing this small plant, patient care today yields towering growth tomorrow. Your wealth will flourish similarly. If this breakdown of simple money lessons resonated, follow for more practical advice. Your future self will thank you endlessly for taking action now.